Hello guys and welcome back. Today we're going to talk about a company that I have talked about before. It's Google, or as is mostly known, Alphabet is their current name. And this is a company that in my last video it kind of tended to be a little bit overvalued, but things have changed tremendously since then. And this is why I wanted to make an update video and kind of examine the company here. Now, if we take a look at the social trends here, you will notice that the company is not very trendy right now. And this is a thing that I generally like to see when I'm buying a company, because I want to be buying it before the actual trend happens. I want to be buying it when things are silent and the company is doing nicely, and actually wait for the trend to happen later. This is my preference, and should be your preference. You need to be buying stocks when there is not too much trend around them, and actually wait for it to happen later on. If the companies are good, of course, it actually even helps even more propel that stock upwards. And so let's examine the company here. It used to be 3,050 almost dollars here, and it's down 9% from its recent highs. Now you will see that the P ratio of the company has been about 25, which some could think it's a little bit more expensive, but for a tech company that's growing that much, I think it's very, very fair. And you see the X here, which is an automatic if it's more than 20, but it doesn't mean that it is a no buy, of course. It just gives you a little bit of a quick way to actually check whether the P ratio is within limits. But again, you have to evaluate as a person, and 25 for a company like Google, especially if it's down from 65 and growing nicely, I think it's more than fair. The price to free cash flow, right? Likewise, it may seem a little bit more expensive than what you'd like to get, but you need to actually account for what the company is doing financially. And this is what we're going to do with our discounted cash flow model a little bit later, so stay tuned. Now, the key metrics here are doing very well. You will see the 5-year revenue growth keeps increasing, the net income growth even better, and the free cash flow growth also increasing nicely. So all these values are increasing very nicely here. But the thing that I wanted to point out here, which really surprised me, was the outstanding shares here. And look at this. This is the 5-year. The 5-year decrease in the amount of outstanding shares is 55%, which is absolutely insane. Look at how much it used to be here. And when I first saw this from my tool, I thought, is this a mistake? It looks very low. And then I went to Yahoo Finance just to double check. And it's actually the correct one. It's 315 million here. So this value is absolutely correct. And it is a 55% decrease in the outstanding shares here, which is absolutely amazing. And so I was a little bit more curious on why this happened, and then I took a look at the cash flow statement of the company, and especially the quarterly statements here. And take a look at this. The common stock repurchased here, look, 7 billion, 11 billion, 12 billion, 12 billion, 13 billion. And if you also take a look at the annual one, you will see that for fiscal year 2021, the company has repurchased 50 billion in common stock, and the previous year 31 billion. So they keep buying back shares, and this is why the outstanding shares count keeps decreasing and decreasing. And again, we're looking at a count that is almost half, actually more than half, less than half than what it used to be 5 years ago, which is absolutely insane. And this means that the value of your stocks, if you were holding stock over here or even here, the value of your stocks has intrinsically doubled, more than doubled, because there is less of it. And so you will eventually see that in the stock count, in the stock price, I'm sure. And we need to examine whether we're actually seeing it today, whether it's already factored in. This is what we're going to be doing next. And of course, the tool provides a lot of other interesting metrics here, like the price to sales ratio or the price to book ratio. But again, these are helpful measures that are not the end all be all, because they are dependent on the industry, and what is the company doing financially is the thing that you want to be examining for the most part. And this is a company that we're talking about. Google is almost like a free cash flow printing machine, as we'll see. And you can actually see that very closely in the cash flow statement. If you take a look at the free cash flow that the company is generating, look at the increase here from 24 billion over here to 31, 42, 67. So the company is pretty much printing money. You will see the net income is also on par with the increase in free cash flow. We want to see that. We don't want too much free cash flow without net income, of course, because profit has to drip into the free cash flow. That's the appropriate way to make money. And so the stock evaluation tool is what we're going to be doing next. And now we're going to actually examine the company's financials, the metrics that we have This is a very handy table here, and these are the handy averages. And so as you'll see, the last year revenue growth of the company was 41%, which of course we cannot project into the future. That would be way too much. But the 3-year average has been 24 and 24, and almost the same for the 5-year average. So what we can do is go a little bit, we'll go a little bit conservative as usual, so go 18, 20, and 22. And of course, in your projections, you could go even lower if you are more conservative than this. And it pays to be conservative. I mean, you give yourself a margin of safety. And when I open up the tool to people, then you will be able to use your own projections, as many as you like. And by the way, if you are not a subscriber, you may want to subscribe, because I will be letting people access the tool at some point. So you may want to stick around and learn more about it. And please leave a like as well in the meantime, because that really helps a lot too. And thanks for that. So the net income margins, again, similar. 21, 29 has been the best year here. For the last year has been amazing for Google, for Alphabet. But then we're gonna go a little bit lower. We're gonna go 17, 18, and 19 here. And the free cash flow margins, again, very similar. You like to see that. We like companies that are fairly consistent with their metrics. And we're gonna go 80, 90, and 100 here. And the annual return, I typically want to make 13%, because 10% is what I can make from a standard S&P 500 ETF. And so if I hit calculate here, you will notice that with our current price being at $2,700, the low estimates for the company's max price to pay today is $3,100 basically. And 4,000 is the medium and 5,000 is the high. So according to all of these estimates, the current price is undervalued based on the projections over here. And so right now, this company looks like it's a very, very interesting buy. And I'm actually thinking about adding some to my portfolio, especially since there's going to be a split, which will propel the stock a little bit more, at least for a little while. And so that was the video that I wanted to make. I think that gives you some ideas about Google, and hope you enjoyed it. Please leave a like if you did. And if you did enjoy this video, take a look at this other one that I made earlier. It talks about Alibaba and some recent news about the company. Thanks a lot for watching this, and I'll see you soon. Bye-bye.